All right, good morning. Let's start our session today. We are in chapter 6. We are in Introduction to Securities, level 1. And today we'll talk about chapter number 6. And chapter 6 talks about derivatives. Okay. And in this chapter, we will cover overview of derivatives, futures, options, interest rate swaps, derivatives exchanges, and investing in derivative markets. And 4 questions from this chapter. Okay, let's start. First of all, about derivatives overview. It is a financial instrument. It is not a product, right? So derivative is actually based on some stocks, we say underlying assets, right? So derivative is based on other asset. This another asset, it can be shares, it can be bonds, it can be index, right? We say underlying asset. So that is why we say derivative is not a product. It is an instrument. You can say it is kind of a facility. The value of derivative is derived from the value of another asset, we say underlying asset. Derivatives provide a mechanism by which prices of assets or commodities can be traded. So basically, derivative is trading in the prices of the commodities or assets. Commodities can be what? Commodities can be, let's say, gold, platinum, silver. You can say also, let's say, oil, gas. These are all commodities. So derivatives can be purchased for financial instruments, the shares or bonds, and also can be for commodities. Without the full value of the transactions being exchanged or traded. If I have to give you some example, let's say, suppose you have 1 million shares bought at 10. Let's say in, let's say 6 months before. Now market price, now let's say 6. How much you bought at? You bought at 10. Now it is 6, right? You have 4 million dirhams loss. That's called holding loss. That's called what? That's called holding loss. Now, if market price is 6 dirhams, what you would like to do? If you feel market price can go further down, better you sell. If you feel market price will go up from here, market price will rebound, it will go to maybe 7, 8, 9, then of course it is a buy time. So to buy, if you want to buy 1 million shares again, you have to arrange 6 million dirhams. But you have no money with you. There comes derivatives. So derivatives is a facility, is an agreement, is an instrument which allows you to book the price, buy later and pay later. Take delivery later and pay later, but price will be booked now. Because you know price can go to 7, can go to 8. So you want to arrest, you want to block the price. That blocking the price, let's say you block the price at 6 dirhams, right? So you pay some premium, right? So you are not buying, you are buying a right to buy. You are buying a right to buy. That's called call. That's called call option. We will discuss in the option segment. So this is what a derivative. Derivative is an agreement, is a facility. You don't buy now, right? You don't pay now. You just only book, right? Booking now, and paying later and taking delivery later. That is the concept of derivatives, right? The underlying assets can be bonds, shares, stocks, market indices, stock market indices, and also interest rates. Commodities also can be derivatives, right? Derivatives of oil, gold, silver, metal, corn, wheat. We say commodity derivatives. And also the derivatives also can be taken on currencies, foreign exchange. Trading of derivatives can be OTC and exchange traded as well. What is OTC? We say over the counter. Over the counter. It's called OTC. Over the counter means the transactions between two parties directly without any exchange involved. We say OTC derivative, right? Let's say you and me. We can also have some gold future trading, right? Between you and me. We say OTC. If we are going to some exchange, let's say Dubai Gold and Commodity Exchange, London Metal Exchange, for example. So exchange, when you go to exchange, that's called exchange traded. So derivatives can be traded in the exchanges. Also, it can be traded between known counterparties. Okay. Uses of derivatives: hedging to mitigate the loss, speculation to speculate and make profit, anticipating future cash flow, asset allocation changes, and arbitrage. Again, what are the uses? Why a person takes derivatives? Why a person buys derivatives? To mitigate loss. If you remember, you bought shares at 10 dirhams. The at price now 6 dirhams. You are losing 6 and 10, you are losing 4 million, you are losing 4 dirhams, and you are having 1 million shares. So you are losing 4 million, right? You are buying call option to why? Because you feel if price goes to 7 dirhams, you can make 1 million. It's not a you are going to make 1 million profit that will mitigate your 4 million loss. So the purpose of derivative can be to mitigate the loss. So in this scenario, your purpose is to recover your some losses. That's called hedging, right? Another example. Then coming speculation. Suppose you don't have any shares, right? You have no shares, but market is falling down or market is going up. You are buying some stock without you having any existing losses. So the motive is to make profit, right? So if you don't have any shares of this company and the share prices may go up, right? So you are buying call option, right to buy, you are buying derivatives. The purpose is to make some profit. That's called speculation. And if you are already having shares and you are having already existing losses, now your purpose is to reduce the loss. That's called hedging. So hedging is to mitigate the loss and speculation is to make profit. Then anticipated future cash flow, right? Suppose you are my financial advisor, you are my portfolio manager. You said, Aditya, market is very good and let's buy derivatives. Price will go up. Example. I can say, come on, you didn't, uh, you are calling me, Aditya, let's market is very good. It could go up. Let us buy 1 million shares at 6 dirhams. I can say, look, I have no money. Yesterday only, I booked an apartment. I bought an apartment. Why didn't you tell me? But look, I can get money next week. I can give you 6 million next week. But you feel by next week, the price could have gone up. So our strategy will be to arrest, to block the price, right? So after 1 week, we can get the price and we can buy that. We can take delivery of those shares. That's called anticipating future cash flow. Then coming arbitrage, simultaneously buying and selling the same asset in two different markets, also called derivatives, right? Let's say MR company. MR company shares, let's say 11 dirhams. Let's say MR company is dual, right? MR company is dual listed. Dual listed means it is listed in DFM, Dubai Financial Market in UAE, and for example, it is also listed in Indian market. Maybe in DFM the price is 12, but in India the price is 11.90. So you can sell in UAE and you can buy in Indian market. That's called arbitrage. So same time buying in one market and selling in another market of same share is called arbitrage. So arbitrage is also a part of derivatives. Gambling is condemned as antisocial, but speculation is considered useful for the producers, right? Let's say speculation. Speculations can be for shares, can be on bonds, also can be on commodities, metal, oil, gas. So generally, many places, producers, manufacturers also buy commodity derivatives to hedge against their cost. If the cost is going up, right, they can buy derivatives to have some mitigating loss. Okay, then this is all about derivative general overview, right? And we are going to discuss in details going forward. Now let's talk about future. What is future? Right? We are discussing derivatives. Under derivative, so let's understand here. Derivatives are of various types. One is future, and second options, then swap, then interest rate derivatives. That's called interest rate swap. So derivatives can be for future, option, swap. All we are going to discuss one by one. Let's talk about what is future. Also, there is a legally binding agreement, right? So future is what? Future is a legally binding agreement between the buyer and a seller. Delivery of a particular pre-specified quantity on an asset at a pre-specified future date and pre-specified amount of money. Understood? So let's say you want to buy gold. Let's say gold price going up. You want to buy gold. Okay, no problem. Go to, let's say any jewelry shop. You buy. You can pay cash and buy. But you want to buy gold future. You don't want to buy physical gold, right? You want to buy gold future. Why you are buying gold future? To take advantage of the rising prices or falling prices, right? So basically, you are trading on the price. You are not buying the gold. You are buying the gold future, right? You don't intend to buy physical gold. You are trying to make money out of the price changes. That is why you are buying gold future. So gold future means what? You have to take the delivery. You have to pay the price and take delivery, right? At a certain future date and at a price specified now. That is the future. Future is a contract agreement. It has an expiry date. Let's say expiry date is, let's say, July, right? And we are, let's suppose, in the month of May, or in the month of, we are in June. So you can have a future contract. Let's say gold price is $510, right? In July, you pay $510 and take delivery. Maybe in July, maybe price is 570, but how much you pay? You will pay only 510. Suppose in July price is 490, but still you have to pay and take delivery. That is called legally binding agreement. Future is a legally binding agreement, right? You bought at 510, you have to pay 510. Even the price is 490, who will bear the loss? You have to buy. That's called legally binding. So future is a legally binding contract. You cannot say I don't want. Okay. So we are discussing in detail going forward. Entering into transaction called opening the trade. The first transaction, right? When you buy a gold future, that's called opening the trade. And eventually delivery is called closing out the trade. In July, you are, let's say price is for 570. You have to, how much you will pay? You will pay only 510. That is agreed price. But you are going to get, you are going to pay 510, but price is, let's say, 570. So you are making $60 profit. But if price is 490, you cannot say I don't want. You have to still make payment 510 and take delivery. So you lose your, let's say, $20 you lose, right? So when you square up the transaction, right, that's called closing out. So opening the trade and closing the trade. The definitions of these key terms. Long means position taken by the buyer is called long. The person who is going in the long contract committed to buy the underlying asset. Underlying asset here, let's say gold future, right? So that's called underlying asset, or it can be, let's say, silver future, right? It can be also oil future. So those are called underlying assets. So in future, what you do, you take the position, that's called buying position. You are going long. Long means buy. So the price will be fixed now, and in the future date, you pay and you take delivery. That's the concept of future, and you are committed to buy. It is binding agreement, right? If the price is low, let's say maybe agreed price, I just now explained again, let's say agreed price is, let's say, 510, but in July price is 490, but still you pay 510. That's an obligation. Open means initial trade, right? Buying the future, we say, of opening a long position or selling a short position. What is short position? Long means buying. Long position means you feel market will go up. If you feel market will go down, so you sell the future. That's called selling a future. So buying a future and selling a future. Selling a future means you want to sell. Buying a future means you want to buy. Close means what? The physical assets of the underlying. Most futures are opened, do not end up being delivered. Means what? Let's say, for example, you have a gold future and the price agreed was 510, right? And in July, let's say the price is 520, right? How much you will pay? You pay 510, right? And you will get gold worth 520. Sometimes you say, no, I don't want gold. I don't want to take the physical delivery. So you will not have to pay 510. So you get only the difference, $10. That's called closing, right? That's called closing out. The physical assets underlying futures do not end up being delivered. It means you don't neither you pay nor you take delivery. What you ask for? You ask for the differences. That's called, the opening buyer will almost invariably avoid delivery by making a closing sale, right? So when you do not take delivery, you ask for the difference. How much you will pay? You should pay 510 and you should get 520. So you will neither pay 510, don't take delivery. You ask the other broker, the seller, to give you the difference between 510 and 520. So the broker can give you $10 difference. So you are not taking delivery. That's called closed in. That's called closed out instead. Right? That's called closed out instead. It means what? You don't take the delivery. You don't pay. You just ask for the difference. That's called closed out. So most of the futures, they do not end up being delivered. It means no delivery happens. Actually, the contracts, the agreements are, the difference amount is settled, is called closed out instead. Underlying means it can be any asset, stocks, shares, futures, bonds, your index future, your currency futures. Those are called underlying assets. Basis, the basis quantifies the difference between the cash price of the underlying asset and the future price. Let's say gold cash price, let's say 505. So you want to buy, you will pay cash, right? So cash, so that's called cash transaction, right? You are buying and paying cash 505. That's called cash market, right? But if you don't want to pay cash now, but you want to book it, that's called future price. Let's say you are not buying cash in the cash market, you are buying a future, gold future, and gold future price maybe 507, for example. That's called future price. So cash price 505, future price, right? Your 507. So $2. That's your that's your difference is called basis. Basis means the difference between the cash price and the future price. Delivery date is the date on which the transaction takes place and so represents the end of the future's life. So if you have taken a gold future at a 507 in the month of July, you pay 507 and you take the gold, or you can ask for the difference. So once you close the transaction, that's called the end of the future contract, right? If you have bought gold future, you have to either you close it or you take delivery. So with that, the opening trade which was taken by you, that becomes closed. So the future contract becomes closed. Covered, covered when the seller of the future has underlying asset that will be needed if physical delivery takes place. Please understand concept. Suppose you bought from me gold future at 505. Let's say you bought from me gold future at 505, and at expiry date, let's say price is 525, right? So if you have bought gold future at 505 and price is 525 at the expiry date, you can say, Aditya, I want to buy gold. So you will pay how much? You will pay me 505, and I will give you gold worth 525. Clear? Suppose I don't have gold with me, right? See, you have to pay 505 and I will pay you gold. And that gold, how much market price? 525. So basically, you are gaining $20 profit and I am going to lose. So if you say, hey Aditya, I want to take delivery, you will pay 505 and I have to buy the gold from the market and give you. Suppose I have already gold with me. It means it's covered. The seller, I am the seller. I have the underlying asset with me. And when you say, hey, Aditya, I want delivery, I can give you the gold because I have already gold with me. If that's called covered. So I am covered. Suppose I don't have gold with me. What I will do? I will take your 505. I will go to market, buy gold at 525 and I will give you. That's called uncovered. So if the that's called negged, also called uncovered. Covered and uncovered. Negged, also called uncovered. So uncovered means the seller. That means I am the seller. I don't have the physical gold. If you want delivery, I have to buy from the market and give you. That's called uncovered position. So covered position, the seller is already having the asset, he can deliver. Uncovered, seller is not having the asset, the seller is not having the gold. When the buyer is demanding, the seller has to buy from the market and give to the buyer. That's called naked position. Key features of futures: exchange traded and also can be, and we saw earlier, the futures, the derivatives can be traded in the exchange, also can be in OTC market. And it is dealt on standardized terms, right? Standard means what? You can say, let's say you want to buy gold future. There is a standard, let's say 11 ounce. That's your contract size. You cannot say I want 100, I want 100 grams. You cannot say I want 1 kilo. There is a standard, specific quantity and size. Future contracts are marked to market. That's called M to M. Marked to market, right? Means what? Suppose you bought gold price, it was fixed at 510. Now tomorrow the price is 512. So these 2 grams will be added to your account, right? So every day evening, the future contract, the difference is the agreed price was 510. Now gold price today, the closing price is 512. So $2 will be added to your account. That's called M to M, mark to market. That's called M to M. Every day the gold price will be adjusted against your, when compared with your agreed price. Suppose let's say the price is actually 50508. So $2 loss also will be to your account. Future contracts give the buyer an obligation to purchase and the seller an obligation to sell an asset at a price decided now, but delivery in the future point of time. So if you buy gold future, suppose you bought your gold future, 510 was the agreed price. Now price became 508. You must buy and pay 510. Even though the market price is 508, it's a loss to you, but you have to take delivery. Either you take delivery, pay 510 and take the delivery of the gold worth 508, or you can pay as the difference. That's called closed instead, right? So when you don't take delivery, that's called closed instead. And here remember, the future is an obligation, right? You cannot say no, I don't want. Who will bear the loss? You have to pay, right? So future contract is an obligation. And we are also going to discuss about options. Options are not obligations. Options are rights, and future contracts are obligation to buy or sell. If you have sold future contract, you have to give delivery. You have bought future contract, you have to purchase. Either you take delivery or you give the difference. Similarly, if you have bought a sales contract, sales future, means you are obliged to sell. If you don't have the gold, you can pay the difference. If you have the gold, you can give delivery. So basically, just hold on please, 1 second. Hello? 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 Sorry. So future contract is an obligation to purchase and obligation to sell. If you have sold future contract, you are obliged to deliver. If you have bought future contract, you are obliged to take delivery. The assets often traded in future contracts include, it means future can be taken, future contracts can be bought for commodities, stocks, bonds, grains, precious metals, and these are called your underlying assets. What do you say? Underlying assets. Next, we'll talk about options, right? So, option is another derivative. As I mentioned earlier, derivatives can be, it can be future, it can be options and swaps. So, future is over. Remember, future is an obligation. Future contract is obligatory. Now, coming options, right? So, options is another way of derivative, another derivative contract. And the option means what? Options means your choice, no obligation, right? No commitment. If you want to buy, buy. If you don't want to buy, not a problem. But in future contract, those are binding. You have to pay. You have to take delivery, right? You have to pay the price. That's future contract. Whether you have bought long, long means buy. You have got long means you are bullish. You have bought. Short means you have sold. In both the cases, you are obliged. Future contracts are obligatory. Now coming options. So options, now coming to the same concept of shares. Remember, you have bought 1 million shares, example here, right? You have bought 1 million shares at $10. Now price now 6, you are losing 4. So you are buying derivative. You are buying option, call option. You are buying call option because you feel market will go up. So you would like to arrest, you would like to book the price because you don't have 6 million to pay now. So possibly you may get money in the next week after 10 days, but by that time price would have gone up. So that is why derivative allows you, hey, don't worry, you don't have cash and you feel market will go up, you would like to book it, you would like to take the booking. Yes. So derivative gives you booking, right? So you can book at 6 dirhams and in future, after, in future means not future contract. In future means at expiry date, right? Every contract, whether it is option or future, it has an expiry date. So within the expiry date, if you feel you want to buy, you can pay 6 dirhams and you can take delivery. If you feel no, I don't want to take, price is not good, let's say price has come down to, let's say came down to 5, you can say I don't want. So options giving you some choices, not obligations. Options gives you rights, right to buy, right to sell. But future contracts, they are obligatory. Future contract, you have to deliver, you have to purchase, right? But in option contract, those are not obligatory. Those are with rights. Those are with options. As the name says, options. It means you get a right to buy or a right to sell. No obligation. Let's understand. Yeah. Let me give you an example. Same thing. Suppose strike price. Strike price means the option price. Let's say 10 dirhams, right? Let's say market price may be 11 dirhams or 9 dirhams, for example. If you want to buy 1 million shares, you have to pay 9 dirhams, 9 million. But you feel I have no money, I cannot buy. But you feel price will go up. So you are going to buy options, derivative contract, right? And the option price, the derivative price will be not same as mark. This is your, let's say, cash price. So basically, this derivative, your call price, little bit higher than the market price, right? So let's say you agreed. That's called strike price, also called agreed price, also called exercise price, 10 dirhams. So you bought call option. So call option means that gives you a right to buy. Now price went to, let's say, 12. So you will exercise. What you will say? Hey, I want my shares. So price has gone to 12 and it is in your favor. So you will exercise. You will exercise the right to buy. So you will, how much you will pay? You will pay 10 and you will get shares worth 12. You are getting 2. That's your profit. Right? Now to buy to buy call option or put option, you pay something premium. Let's say 25 cents per share. You have paid premium. So you get 1.75. That's called your net profit. And premium is paid by the buyer. Whether you are buying call option, the right to buy, or put option, right to sell. What is put option? What is put? Put option means a right to sell. Right to sell. So you feel market price will fall down. So you buy a right to sell. Suppose now you are buying a put option. Let's say strike price at 10. Now price fell down to, let's say, 8. That is good. You have bought put option, right to sell. Right? Agreed price, strike price, agreed price, also called exercise price, all are same. How much it was agreed? $10. How much price now? $8. Right? So you will get, so you will exercise. You will exercise the right. And how much you will get? You will get 10. And market price how much? 8. So you are having $2 as profit. And also you paid premium. Why? Premium is paid by the buyer. Either you are buying the call option or buying the put option, you will pay the premium. And you are called holder. Holder means buyer. Buyer always pays premium to the seller. And buyer is having right, but seller having obligations. So either you buy call option. When you buy call option, when you are bullish, you feel market will go up. When you buy put option, you feel market will go down. That's called bearish market. That's called when you are bearish. BARISH, bearish. Bearish means market going to crash. That's why you are buying put option. So this is ideas. Let's understand. Option gives a buyer a right but not the obligation to buy or sell a specified quantity of an underlying assets at a pre-agreed, that's called exercise price, strike price, or also agreed price on or before a pre-defined future date or between two specified dates. So basically every call option, put option is also having an expiry date. Before that expiry date, you have to exercise your right. Right? So you can, if you have bought call option, you can say, hey, I want to buy. If you have bought put option, you can say, hey, I want to sell. Right? You will buy when? If the price has gone up to 12 dirhams. But if the price went down to 7 dirhams, understand, you have bought a call option at what price? At $10. Now price became 7. it is it is not in your favor, right? It's a loss. So why you will pay 10 dirhams when the market price is 7 dirhams? So what you do? You abandon. What you do? You abandon. Leave it here, I don't want, because you don't have the obligations. You have the right to buy. Right? And how much premium you paid? Premium you paid only 25. That's your maximum loss. 25. So for the call option holder, means buyer, right? For the call option, you have the right to buy and you don't have obligation. If it is to your favor, if market price goes up, you can say, hey, I want to buy. How much you will pay? $10. But if market price goes down to 7, you don't have to buy because you are not obliged. But in future contract, you are obliged. But in options, you are not obliged. If you want to buy, buy. If you don't want to buy, you can say, I don't want. So if you don't want to buy because price has gone to 7, why you will pay 10 and price is 7? You can abandon, right? So what you do? What you pay? The whatever premium you paid, the premium 25 fills you have paid, that's your maximum loss, right? So for the call option holder, for the right to buy, the profit is unlimited, right? Let's say market price became 8, 12, it can be 42 also. So you get unlimited profit. But on the downside, the loss is limited. Even though suppose you have, even though the price went to 7 and agreed price 10, so that is a 3 dirhams loss, but you are not obliged. You can say, I don't want to sell, right? You can say, I don't want to buy. So what you lose only the premium paid. And remember, premium is paid by the buyer to the seller. Whether you are having call option or put option, you are the holder, and the holder pays the premium to the seller, and seller is called writer. Okay. So buy a call option and put option. So let us start, have some example here, right? Then coming something called naked option and also called uncovered option, and one is covered option. Same thing, let's understand. Okay, so we discussed about future and options, future versus options. You can read them, the differences. Now, what is uncovered option, also called naked option, right? Let's, for example, let's take a rough notebook. No, that's okay. We can do it here itself. Suppose you have got a call option, let's say a right to buy, right? Suppose strike price, let's say $10. Now market price became $14. You have got a right to buy. How much strike price? $10. How much market price? $14. Is it good for you or not? Yes. So what you will say? Hey, I want my shares. You will exercise the right. So this 4 dirhams is to your favor. So when you say, hey, I want to buy, the seller, he has to deliver you the shares. If he does not have the shares with him, he will buy from the market, paying 14 and give you at 10. So if the seller is not having the shares, so seller is called, that's called naked option, uncovered option. The seller of the option does not own the shares, right? So when the strike price was 10 and market price 14, it is to your favor. That's what you wanted. You thought price will go up. So you will pay 10 and you will get shares worth 14. If the seller is not having the shares, he has to buy from market and give you. And that option is called naked option, uncovered option. Uncovered option means the seller is not having the shares with him. So when you are the holder, you are exercising the right. You will pay only 10, but that seller will give you shares worth 14. If he does not have the shares, he has no shares with him. Then he has to buy from market and give you. So that option is called uncovered or naked option. And because the seller has sold, he has sold the contract. That's called writer. And seller is called also writer. So in the option, one side is seller, one side is buyer. Buyer is always having a right. Buyer can be buyer of call option or put option. Buyer is always having right, and seller is always having obligations because he took your money. You as a buyer, whether buyer of call option or put option, you have paid premium, and that person, that poor fellow, the seller, has taken your money. So whatever you say, he has to agree. If you have bought put option, suppose you have bought put option, means right to sell. Strike price, let's say 10. Now price went to 8. What you will say? Hey, I want to sell. And the poor fellow who sold you this put option, you have given him money, premium. When you say, hey, I want to sell, he will pay you $10. But market price is only $8. Market price $8. He's paying you $10. So he will lose $2. That's his loss, and $2 is gain for you. So the seller is always having obligations, and the buyer always having a right. Clear? And I can say it's a mirror effect. Whatever your loss, the seller's gain. Whatever your gain, seller's loss. You paid premium, that's the income for the seller. You got money, you got the transaction in your favor. Whatever your profit, his loss. Whatever your loss and his profit. And remember, as a buyer, as a call option or put option buyer, your loss is limited, right? But profit is unlimited. And similarly, for the seller, loss is unlimited and profit is limited. What is your limited loss? Only premium. That's your limited loss. And that is his limited profit. So his loss unlimited, your profit unlimited. Your loss limited, his profit also limited. Your profit, his loss. Your loss, his profit. Right? Your profit is unlimited and his profit, sorry, your profit is unlimited and his profit also unlimited. Your loss limited and his profit also limited. Okay. So if once again, let's say price now 14 dirhams. You got a call option at 10, price 14. So 4 million is your gain. And this 4 million will be loss for the seller, right? So for the call and put option for the buyer, so there is no limit to the profit. So profit is unlimited and loss is limited. And loss is limited to the extent of premium you paid. That's all. Let's see this example. Suppose Jersey company, the shares are trading at 3.24 and an investor buys 3.5 call option for 3 months. This is your cash price. That's your future price. That's your strike price. The investor has the right to buy the shares from the writer. Writer is who? Who has sold you this contract. You have bought the call option. So writer is selling that option to you. So this is your 3.5. That's my, you can say, strike price. So strike price, also called agreed price, also called exercise price. How much? 3.5. Now suppose the price is gone to 6 dirhams. So strike price was 3.5. Now market price is 6. What you will say? Hey, I want my shares. That's called exercising the right. So how much you will get? You get 2.5 grams as your gain. right? So that's your gain. And this poor fellow, he has to give you shares worth 6 dirhams, but how much you will pay? You will pay only 3.5. So either you pay 3.5 and get shares, or you can ask for difference. Ask for difference. No, you can say, no, I don't want the shares. So he can give you $2.5 difference, and that's called closed instead, right? So now, if uh, if Jersey shares are below, now this was the gain. Now suppose price is below, let's say price went to, let's say 3 dirhams. So if price has gone to 3 dirhams, will you pay 3.5 when the price is 3? No, it is not in your favor. So what you can do? You can abandon. What you can say? You can abandon. You say, I don't want. See, you are not obliged. You have the right to buy, right? If it is to your favor, which was in this scenario, market price was 6, you are getting 2.5. That's to your favor, you can exercise. But if the price has gone against you, it has gone down, why will pay 3.5 when in the market it is available at 3 dirhams? You can say, I don't want. That's called abandon. And how much you will lose? Let's say you have paid premium. You have paid premium only 42 cents. So 0.42 only you are going to lose. So for the call option holder, the premium paid is the maximum loss, right? So profit is unlimited, but loss is limited. Okay. You can see this example. Interest rate swap. I think this topic we can take in the next class. Let's not burden you with derivatives. We discussed about futures and options. So let us recapitulate. Futures and options are the derivatives. Under futures, the buyer is always having obligations, and there is a margin money. There is a margin money to be paid. But under the options, call option or put options, the holder is having a right, not obligation, and the holder is the one paying the premium, and his premium can be the maximum loss, but profit can be unlimited. I hope you understood the concept. So there are a lot of more questions are there in the link. You can go through them, and understanding can be clear. In case you still need something, you can always message me. You can give your name and all. You can message me. That's my number, 0506753 and 526. That's my mobile number. You can always message me. You can say, Aditya, my name is Aditya. Let me write here. You can say, hey Aditya, I have taken your access. I am getting stuck, not able to understand. So possible I can have a phone call. I can send some message. I can sort out all your queries. Okay. Thank you so much. Thank you for watching.